Well, this week Woolworths announced its first ever profit fall because of a $300 million write-down of the Dick Smith electronics business. Undeterred, Woolies is spending $2 billion on new stores this year, in particular on the new venture Masters Home Improvements, an attack on the dominance of Bunnings, and at the same time it's bearing down on costs to deal with food price deflation. Now, the bloke in charge of all this is Grant O'Brien, a 24-year Woolworths veteran who took over as CEO last October. He made some time for me this week after the results presentation. Well, Grant O'Brien, it seems that the central issue with Woolworths at the moment is that you've got a huge capital expenditure program, especially with the home improvement store rollout, the master stores, while at the same time your leadership in food is coming under siege.
I think we reported during the week, Alan, a solid result for our business, including our food and liquor business. But it's also true to say that we're investing in future growth. So our challenge is really clear, and that is to ensure we maintain momentum in our core business, but at the same time provide the platform that we need for future growth.
You're not breaking out food from liquor, but it does seem as if the food business is going backwards at the moment. Is that right?
No, our food business isn't going backwards. Our liquor business is performing strongly. That's true and has done for some time. We're gaining market share and making strong inroads into the liquor market, and I think we've got a strong model there and a model that has got much more potential and much more room for growth. In relation to our food business, I would say the same of it. I think there's an enormous upside in our food business, and we're resetting our food business in a way to make sure that it's in a position to grow into the future. Areas like fresh food particularly are great areas of opportunity for us. It's not going backwards, it's still growing market share, and we see great opportunities for that to continue moving forward.
But Coles is growing market share in food faster than you are, aren't they?
I don't get to see Coles market share figures, Alan, and it's true to say their comp numbers have been in advance of Woolworths over a period of time. But if you take top line sales, we've got very strong top line sales in our business, and we're growing a footprint of stores that's going to serve us well for many years into the future. So it's not about today, but today's nevertheless important. It's also about what we're investing in our business to make sure that we've got the opportunity for growth moving forward.
Grant, I don't believe for a moment that you don't know what Coles market share is. I mean, I think you'd know week to week.
Coles don't divulge their numbers to the market. We have an idea as to what it is, but we're more interested in what our market share is doing, because it's not a two-player market. There are more players in the market, such as Aldi and the independent sector and the Metcash sector. We keep an eye on our market share, and importantly that's growing, and that's the biggest focus for us.
Do you think you can grow food market share? I think it's 37% at the moment, isn't it?
Well, we can continue to grow our market share because we continue to see opportunities for us to further answer the needs of our customers moving forward, and not just in the traditional way that we've undertaken our business, but in the new ways that our customers are looking to move. So we see upside in the business, but we'll only access that upside if we deserve to.
And the other side to this is profit margin. Now, one of the themes that come out of your results this week is that you're seeing food deflation, and the question is, can you cut costs sufficiently to continue to grow your margin?
Yeah, it's something that we've done over many years. It's the continual balancing act, as you'd know, Alan, about how you've got to manage a business, and your observation is right. There's pressure in terms of deflation in the marketplace, and that puts enormous pressure on costs in a business like ours. But we've got a history of being able to make our business more efficient, and we've got more methods by which to make it more efficient, and we're simply implementing those as we go on. The deflationary effects on our business are really multifaceted, and some of those elements of deflation will cycle. So whilst it is a subdued market at the moment, there are multiple issues in there that are having an effect on sales at the moment for all retailers.
Now, you've got a $2 billion capital expenditure program, including the Masters Home Improvement store rollout. Your return on equity is going to suffer in the meantime, isn't it?
I think our return on funds employed, or return on equity, reflects our investment, or the investments that we're making at the moment, Alan, on a number of fronts. One is the Masters business. The other are acquisitions that we've made in recent times, like the Cellar Masters business, that's now an integral part of our growing and successful liquor business, and also the the fast tracking, if you like, of a number of our supermarket stores. We've delivered 25 new stores in our supermarket business in this half, and a lot of those stores were delivered towards the end of the half. So we reflect the funds employed, but we're not reflecting really any sort of or the returns on those monies yet, and that's safe to say for the Masters business as well.
Thanks very much for talking to us, Grant O'Brien.
All right, Alan, thank you.